Hello, hello. Hi. Today is Thursday, January 12th. Welcome to our NJThrives Small Business webinar. I hope all of you can hear me. And if you can hear me, please put a 1 in the chat. If you can hear me clearly, if you can see me properly, you are here at our weekly webinar created to help New Jersey small business owners start, grow, and thrive. There's a lot of people joining us here today, and I can see, thank you everybody for sharing in the chat. So we want to get started. We're running behind on time a little, but we want to get started. Please feel free to put your name, your business name, what you do, where you're from, and feel free to network in the chat. And we'll get started here. I'm your host, Uzma Sheikh. I'm a coordinator at the NJSBDC. And next slide, who we are. We are America's New Jersey Small Business Development Centers Network. And if you're new here, please let us know in the chat as well. And if you've been with us for a while, thank you. Shout out to you guys for supporting us. We're a statewide program powered by the SBA and partners to help small businesses in New Jersey with 3 things: no-cost small business consulting, training and events starting at $0, and exclusive small business resources. And before we move on to our webinar for today, we have a special guest, Anthony Martinez from the NJBAC, who is the small business advocate. I'll stop sharing quickly and Anthony can share what he's here for.
Good afternoon, folks. My name is Anthony Martinez, and I'm the Small Business Advocate for the New Jersey Business Action Center. First off, I'm going to give you a little information about the Business Action Center and who we are, what it is we do. So the New Jersey Business Action Center operates out of the Secretary of State Department in Trenton. And within the New Jersey Business Action Center, there's 3 offices dedicated to assisting small businesses such as yourself. There's the Office of Business Advocacy that provides site assistance. So if you're a new or existing business looking for a location, we can assist with that. They also assist with project management assistance. Then we also have the Office of Small Business Advocacies, which is where you'll find me. And we provide site assistance also. We provide government assistance. So if you're looking for site certifications, if you want to be certified, small business enterprise or minority business enterprise or women business enterprise or veteran-owned business enterprise or disabled veteran-owned business enterprise, those certifications to do business with the state, we can assist with that. Also, if your business requires a state license, let's say the product or service that you sell is regulated by the state, we can assist you with obtaining that state license, okay, with the department that you have to obtain it from, okay? It might be the New Jersey Division of Consumer Affairs, it might be the Health Department, there's different departments that provide the licenses. And we also provide, in addition to the government assistance, we assist with finding small businesses with finding financial resources. We have a good working relationship with all the SBA lenders and with CDFI micro lenders throughout the state. Also within the Business Action Center, we have our Office of Export Promotion that assists with everything that has to do with exporting. So if you're a small to mid-sized company interested in expanding your products or services through export, companies interested in global business activity can tap into resources like creating an export plan, guidance and identifying global export markets. They guide you through foreign custom procedures. And there's also the availability of the STEP grant, the New Jersey State Trade Expansion Program, the STEP grant, which is can be used to attend international trade shows, for website translations, and also for marketing materials. There you'll see important websites and the NJBAC hotline, the New Jersey Business Action Hotline. There you'll find our website for the New Jersey Business Action Center. The live chat is business.nj.gov. If you want to speak live with one of our representatives, we also have representatives that speak in Spanish. Myself, yo hablo en español. Ofrecemos la asesoría en español, so puedes hablar con representantes en español. And again, that's live. Also, the 1-800-JERSEY-7 number, that's live as well. And again, we answer the live chat and the 1-800-JERSEY-7 number. And there you'll find my contact information. I respond to my emails pretty quickly. So if you have a question, any business related question, please, by all means, reach out to us and we're happy to help. Thank you. Thank you for inviting us to be a part of this. Thanks again.
Of course, thank you for coming, Anthony. We really appreciate it. And just to let everyone know, NJBAC has been a great partner of ours for many, many years, and we always appreciate all their support. So thank you, Anthony, again. Thank you all for your patience. Hang on as we kind of go through our technical difficulties, but let us know if you encounter anything else in audio or video. But finally, getting to the agenda for today, we have our headlines, we have our webinar, and then we'll get to our Q&A. So stick around for our headlines and I'll show you what you should be looking for. And these links will be in our chat. So the first headline, Biden-Harris administration to begin accepting applications on January 9th for SBA Veteran Small Business Certification Program. This was released on January 10th, so 2 days ago. The program has started accepting applications for the Veteran Small Business Certification. If you're a veteran, we highly encourage you to apply and get familiar with the program and apply to the program. And it has all the qualifications, the requirements that you need to meet on here, the background for the program, everything. Again, this link will be in the chat for you, so you can read, on your own and get familiar. And if you're interested in knowing more, if you have questions, please reach out to us. The second headline is for the NJDEC's New Jersey International Trade Awards. There will be trade awards on May 17th, I believe, and the New Jersey District Export Council, they're proud to recognize excellence among the New Jersey's leading exporters. So they will have a form, they have categories: Export of the Year, Service Export of the Year, New Export of the Year, and Minority Owned Diverse Export of the Year. They have the ceremony details and everything, and there is a form. So if you yourself are an exporter and you'd like to nominate yourself, or if you know someone and you want to nominate them, please feel free to go to this link and get familiar. Moving on, things to keep in mind. So type questions in the Q&A box. You'll see in the bar below, there is a Q&A box. Please put in your questions there, not in the chat section. If you put your questions in the chat section, they will get lost because we do have a lot of people. And just to brag for a minute, we have 233 people joining us today as participants. So that's always a good number. And if you want these slides, if you want the slides from Anthony, if you want the slides for the webinars, please complete the 3-minute survey and you will get the webinar slides and all resources related to today's webinar. Now, what you're here for, fundamentals of small business finances. We have our NJSBDC senior consultant, Ryan Silvestri, and I won't take up much of your time. Ryan, please go ahead, share your screen and get started.
Awesome. Mucho thank you, Uzma.
You're welcome.
I will have, I was one of those victims of technical difficulties. So I'm gonna have you walk me through, just make sure I have everything working correctly.
Sure.
Let's see.
So right now I can see you okay, I can hear you okay. So you're perfect for audio and video.
Okay. So let me share my screen. Let's see. And so what do you see now?
And I can see I believe the first slide, finance fundamentals. Why are we here?
Okay, all right, perfect. It's so good so far. All right, now I'm looking for the other section of this presentation, which I don't see to find on my side. Hold on a second. So do you still see just the fundamental slide presentation?
Yes, just the
Fantastic.
finance fundamentals.
Fantastic. All right. So I think we're started. I think we're all
We're
ready
good.
to be awesome money managers now, right? All right, perfect. Well, guys, welcome. I appreciate when we have such a big crowd because that means a lot of us are learning and learning things the right way. So it's the proper foundation. That's why we're here. So the main question as to why we're here for this presentation. So this presentation is about, as you guys can see, finance fundamentals. That's what you all joined up for. And so a quick little introduction about myself. You know, I have a couple of degrees in finance and economics. I've also been with the network for maybe 13, 14 years now. I also practice what I preach. So I'm a business owner myself. And when I combine all those different parts of my past life, you know, one of the things that I kind of see as a trend is a lot of us get stuck in running our business or the main passion that we started the business for. You know, I like to create this or do that. And then sometimes we kind of just skip over the boring stuff, which is the looking at the performance of the business, the planning, you know, the strategic mindset that we should be having. And that's what finance fundamentals is all about. It's making sure that we understand what our business is telling us in the form of numbers. You know, some of us put together a business plan, a financial plan, but very few of us can actually interpret the data and then make action steps based on that data. And that's what this is all about. So that story that the financial plan tells us helps us allocate our resources to the most efficient way possible. It also helps us manage risk and more importantly, achieve whatever the goals are that we have set. You know, obviously the goal is usually to make as much money as possible or to make a positive impact on the community based on why we were there in the first place. But we want to divide those goals into more actionable and attainable numbers. So let's see. Okay. So the way we start is by creating a budget. The budget and the if we are even at the first step of I have an idea, or we've been in business for a couple of years and we're going to go into a new product, a new market, we need to start off with some type of budget, you know, and this budget helps us, again, like I mentioned before, allocate our resources. And our resources are usually time, money, you know, other resources that we might have, kind of goes into all of this. And we have an agenda, you know, more of a feasibility. So if I have, you know, access to $100 in my pocket now, and potentially another $100 of borrowed money, my capacity to do things with is $200. But then I also need to add into that, I have 5 hours a week, I have 10 hours a week, I have 100 hours a week, whatever it is. Now I start to have a base plate for my feasibility of what I can do and what my capacity happens to be. Another thing that helps us do is it monitors and controls our expenses. So we do this by setting budget targets, and we start to compare that on an ongoing basis, which you're going to get into in a little bit, with how closely did I hit this target, and what adjustments do I need to make in order to better align myself with that target. Another thing that we use is on an ongoing basis, outside agencies are going to use this to measure performance, because I can say, this was my budget of what I needed to have for the Christmas season. You know, I need to have an extra 2 people on staff. I need to have an extra $100 of working capital, and I can anticipate for that Christmas budget, and then better allocate my resources then. So it's very important that that all this goes together, and then we can start to forecast. Oh, Another very, very important item here is if we are going to be borrowing money, that budget is called a use of proceeds. And that use of proceeds says, my goal is to get I don't know, $100,000 so that I can buy this warehouse. And this is how I'm going to use the $100,000. Maybe 80,000 is for the acquisition, 10,000 is to do some improvements, and another 10,000 would be for licensing and permits. So that's the budget mentality of what we should have. Let's see. All right. So all of these data points start with the 3 basic financial statements. Now, there are many more financial statements, as a lot of us already know, but the 3 that are the core basic ones that we start with is always the balance sheet, the income statement, and the statements of cash flows. Now, a little distinction. So we're looking at this from a finance perspective. Last week, you guys had something on bookkeeping. So there's a difference between the finance person and the accounting person. So the finance person kind of looks at this, makes decisions as to what we can do for a strategy, looks at this and makes a decision on what we could have done in the past, and then starts to make modifications on that plan. The accountant or the bookkeeper is a person who actually does the recording, the classifying, the summarizing. So there's a nice distinction that we have to make between the two. And one of the most underutilized resources that, or I would say, people that we have out there is our accountants. It's a lot of us use our accountants almost like a bookkeeper. Now, a bookkeeper has a very important job because, again, they're the ones recording, classifying, summarizing, but the accountant is there also as a finance person to advise and look at the numbers, interpret the data, and then give you guys advice on what we should do next for the next quarter to better achieve our goals. So I want to make sure that everybody's using our, our contacts as efficiently as possible. Okay, so we're going to start off with the balance sheet. So the balance sheet here, as it says on the slide, is the financial statement that provides a snapshot of a company's financial position at a specific point in time. The way I like to explain it is almost like a photograph or a picture. I take a quick little snapshot and I say to my money, all right, everybody freeze, where's my money right now? So if I were to take a picture in the morning and a picture at nighttime, things move around and things shift and that picture will be a little bit different. Same thing happens with our balance sheet. So if I pay a bill in the afternoon, that balance sheet is going to look a little bit different in the evening than it does in the morning. So it's a very, very specific point in time. And it says, this is where my money's at right now. I owe this person that much money. This person owes me this much money. I have this much money in the bank. And it just shows where the money is at that given time. The famous equation for or formula for the balance sheet is that your assets will equal your liabilities and your equity. I will go into that in a little bit more detail in about 2 or 3 slides, but the general idea is keeping the idea in the back of your head that I need to make sure that whatever I have on my equity and liabilities has to always balance. So that's something we're going to get into in a little bit more in a moment. And what that means is one side of my financial statement has to have the same number as the other side. So whatever my assets are is always going to be the sum of the money that I owe, and whatever owner's equity I already have built into that business. All right. Oh, actually, I want to go into a little bit more on each of these, before I move on. So on the asset side, what is an asset, what is a liability, and what is an equity? It's actually kind of important to explain these. So in assets, these are the resources that a company owns and controls, like such as cash, investments, inventory, property. Excuse me. So assets are typically divided into 2 categories. You have your current assets, and these are assets that can be converted into cash within 1 year. And then you have your non-current assets. So those are the ones that obviously are, cannot be converted to cash into 1 year, or your long-term assets. Liabilities. So these are obligations that the company owns, or owes, I should say. These are obligations the company owes, such as loans, taxes, accounts payable. So these liabilities are also divided into two groups. You have your current liabilities, and these are the ones that you have to settle or pay within 1 year. And then you have your non-current liabilities. Those will be your longer term debts. And what is equity? So equity, this is the residual interest in the asset of a company after liabilities have been settled. And another way to look at it is, again, this is the money that you've already put into the business, that you've already built and owned, and I guess and just have clear ownership. It's also the base plate of what we use when we start to calculate what the company's worth. That formula is a little bit longer, but we usually start with owner's equity. All right, so let's go into the next slide. So how do we use this? And this is a nice little example of how we use a balance sheet. So imagine that there's a small retail store that sells clothing and accessories. The owner of the store reviews the company's balance sheet and notices that the company has a large amount of inventory on hand. And this may indicate that the company is not selling as much merchandise as it has expected. This could be a concern. And the reason I would say it could be is because we're looking at a whole picture. There's never just one variable that says, this is the one thing that happened that we need to adjust that to fix this. But if we have a lot of inventory in hand, we got to look at a couple of different things. So these are some of the ideas of how I would look at the balance sheet and what action items a business owner might take at that time. So one of the first things they could possibly do is review the sales data and identify any trends and patterns that might contribute to the excess inventory. They could consider doing promotions or discounts if that inventory is just sitting there for too long. Which reminds me, one of the ratios that we would look at on a balance sheet, and a ratio is just a calculation based on data that's found on one of these spreadsheets. It's called an inventory turnover ratio. And that number is just simply says, this is how many times the company has sold or replenished that product in a very specific period of time. And that tells me how good that inventory is doing. So one of the line items, again, on my balance sheet is going to be inventory. I can calculate a little bit of a ratio and say, this is how many times I had to replenish that inventory. And that tells me, is this a good seller or a bad seller? And then as a business owner, I start to make more informed decisions as to what does my market really want and how can I meet those demands of the market. So let me see other items that or other action items that a business owner could do. They can evaluate inventory management systems. If you don't already have some type of POS or inventory management system in place, that might be something that can feed into the data that the balance sheet is telling you. And again, you're making better, better adjustments. And maybe consider adjusting the company's product mix. So if I have something that sits on the shelf for too long, something that I might be able to do is be more aware of the needs of my community, or my market, and start to modify that if I see that that inventory turnover ratio is not working in my favor. So using a balance sheet is always a good starting point, to start making a lot of these adjustments that will hopefully, make a good impact on the bottom line. And when I'm looking at investing into a company or even a stock, I personally start off with a balance sheet. I'm always a balance sheet trader. And because it tells me how much cash does the company have on hand. As another one, days of cash on hand, that comes straight from the balance sheet. And that says, if like what we just went through the pandemic, if something were to happen and my customers can't come to me because the market says that, it's too difficult or something, physically in your area, like, a road closure or traffic being diverted somewhere else, how many days of cash can I sustain my business with what I have on hand? And that's what that means. And that comes from your balance sheet. So let's take a look at an actual balance sheet. This is what one looks like. And again, for anybody who would want to look at this a little bit deeper, we provide a lot of resistance, but a copy of this presentation will be available to you guys. So one of the things that we look at is we start off with the time frame up on top, which says, or the time, this is December 31st. Usually it's the end of the day on a given particular day that we pull a balance sheet. So that gives us a little bit of a scope of when this is taken, and we use this data more efficiently when we have something to compare it to, ideally year over year. So how does this, in this example, December 31st, 2021, how does that look like to December 31st, 2020, or 2022? And then now we start to make comparisons. This is the direction of the trajectory that my business is moving into. And then I can look at what decisions and what events happened that year that took me to that place. And sometimes some of those data points are good, some of those data points are bad, but we got to learn from the bad and take advantage of the good. So some of the other things that we want to do is review what's on the assets. So if you look here, the left side is divided into, like I mentioned before, your current assets, which are all the assets that could be converted into cash within the next 12 months. And then on the bottom, we have your non-current or long-term assets. So that's going to be your PP&E, or property, plant, and equipment. And these are things that again, we're not converting into cash immediately this year. Another tripping point here is people say, all right, well, my building, it says here, is 180. And in most of our backyards, there's no building that's worth 180. But we always put down on the balance sheet the number of the original cost or the original improvements. We don't include market prices. So even though that building might be worth $1 million today, we bought it 10 years ago and it's 180,000 when we bought it, and it's 180,000 on our balance sheet. Now, there are other financial statements and other ways that we can say this is what the market rate is of that building, but because that number is going up and down, we don't include it on the balance sheet. So same thing with any land improvements, or any equipment. We always put down the number that we paid at the time of the acquisition of that asset. So then on the left side, we're going to look at the liabilities. It's the same thing. On the top side, all the liabilities that are due within the next 12 months, and the bottom ones are the ones that are due a little bit longer, longer out, like the mortgage on the building as an example. We have here notes payable, some bonds. Most of us probably wouldn't be getting into bonds, but tax deferred, so if we're on a tax payment plan and we have to, or we're deferring taxes for some type of incentive program, those go on the long-term liabilities. And on the equity. So the way that we calculate the bottom line of the balance sheet is actually on the right side, we're looking towards the bottom, something called total stockholders' equity. And what we're doing is that we're subtracting total liabilities, the 481, from the total assets, the 770, and that gives us a total equity that we have into the company. And then the balance that I was talking about is right underneath that and says total liabilities and stockholders' equity is 770, and that is equal to the number on the left side, which is the total assets, the 770. So we want to make sure that that's always balanced, and doesn't always balance, and a lot of it is usually just accounting errors or bookkeeping errors, and then we got to go back and find out where the data is. That's the most common one. Sometimes it's just that we didn't record the data. So, but this is a good snapshot of where our money is and what we need to do to better control our account receivables, our accounts payable, stuff like that. That's another good ratio that I like to use, which is on my accounts receivables. So if your business model does have a lot of invoices that it sends out, another financial spreadsheet that we're not going to get into today, but it's good to just know about in the back of your head, is something called an aging statement. So an aging statement just says, these are all the clients or the companies and individuals that owe me money, and how quickly am I collecting on that money. And that could also tell us how efficient our system is at collection of that money, because there is a time value of money, and $1 today might be more valuable than $1.10 tomorrow. So it's very important that we keep our eyes on how quickly we're collecting that money for those account receivables. All right. Okay. So the income statement. This is the next one of the more powerful ones here as well. So as it says here, an income statement, also called a profit and loss, or sometimes a P&L, is a financial statement that shows a company's revenue, expenses, and profit over a specific period of time, typically a month or a year. The income statement is used to determine the company's profitability and financial performance. And the formula for this obviously is the what we see here: revenue minus expenses equal to profit. Pretty pretty straightforward, pretty obvious. But the income statement is what we look at to determine one of the first clues to determine how a company can start to pay its bills if we want to take on new bills. And so if we're applying for a loan, we're looking at how much available cash do you have, in profit, and we have different lines of profit, which we'll go into in a little bit. And that says, I have the ability to take on the loan. And an easy example is, I want to borrow $100,000 and my monthly payments are $500. Through the income statement, it'll show me, do I have an extra $500 left over on a regular basis throughout the year to pay for that, $500 minimum payment. And that's as simple as I can put it. One of the calculations, or one of the ratios that we use here, something called the debt service coverage ratio. And that just means how much of the debt can we service or can we cover through the money coming in from our operations. So that's very important to know. So let's define some of these terms. We have revenue, expenses, and profit. So revenue is a total amounts of money that a company earns from sales of its goods, its services, but not all income is revenue, and that's actually really, really important. So, for example, if I am an airline company and I sold a ticket, somebody just bought a ticket for next year, depending on the accounting system that I'm using, I might not count that as revenue because I didn't earn the money yet. So it's very important to have these conversations with your accountant. There are different, there's cash and accrual basis is actually what I'm referring to. And depending on what accounting system I'm using, most airlines don't recognize that as earned income. So they don't put it down on their revenue line because they didn't earn it yet. So they can't count it as revenue. So it's not counted towards this formula. Another example could be if I buy parts I'm a manufacturer and I buy parts and I have to buy my steel, let's say, from one country, and I have to then send an assembled or almost assembled part to another country. Well, while I'm buying that steel from one country with American currency, there might be a foreign exchange difference that works in my favor. So I actually earned a little bit of income just by buying the steel from another country in American currency, if that currency pair happens to be in my favor. So my actual currency position, my cash position, did go up, but it's not because of revenue. So it can't be counted as revenue. So that's just an example. It doesn't apply to most of us in that last example, but those are two examples I just thought of off the top of my head that could offset the revenue if it's not accounted correctly. So expenses. So these are the costs that a company will incur in order to generate the revenue, such as the cost of goods sold, selling, any general expenses, research and development, stuff like this. And we'll go into it in a moment, but not all revenue or not all expenses, I apologize, not all expenses is going to be counted in the same place. And that's another common mistake that I've seen with a lot of businesses when they put their financials together, what goes into cost of goods sold and what goes into operating.